For the second week of your personal finance module, we will be focusing more on investment planning. We start off with understanding the relationship between risk and return in making sound financial decisions. In investing, there is a direct relationship between risk and return because investors will demand more compensation for sharing more investment risk. To invest is to take risk, and to invest is to separate yourself from your money through actual distance, where you literally give it to someone else, or through time. There is always some risk that what you get back is worth less or therefore costs you more than what you invested, therefore you have a loss, or less than what you might have had if you had done something else with your money, which is an opportunity cost. The more risk you are willing to take, the more potential you can make, but the higher the risk, the more potential losses and opportunity costs you may incur. Investment risk, therefore, is the idea that an investment will not perform as expected. That is, the actual return will deviate from the expected return. Risk is measured by the amount of volatility, that is the difference between actual returns and average or expected returns. And that difference is referred to as standard deviation. Returns with a large standard deviation, showing the greatest variance from the average, have higher volatility and are the riskier investments. And what risks are there? What would cause an investment to unexpectedly over or underperform? That means your investment would have an exposure in economic risk, industry risk, company risk, asset class risks, and market risk. Returns, on the other hand, are value created by an investment through either income or gains. Returns are also your compensation for investing, for taking on some or all of the risk of the investment. Even if there is no risk, you must be paid for the use of the liquidity that you gave up for the investment, and that is the process of your investing. Returns are also benefits from investing, but they are much larger than its cost. And there are at least two costs investing. That is, one, the opportunity cost of giving up cash and giving up all of your other uses of cash that until you get it back into the future. And the second one is the cost of the risk that you take, and that's the risk that you won't get it all back. Therefore, returns are always calculated as annual rates of return or a percentage of return created for each unit or dollar of the original value. Investment creates income or investment gains or losses of value, and therefore that's how the returns are created. What is investing? It is an act whereby you commit money or capital to an endeavor with the expectation of obtaining an additional income or profit. Simply put, investment means putting your money to work for you, which maximizes your earning potential. Essentially, investing is a different way to think about how to make your money. What's the difference between investing versus that of spending? Also, what's the difference between investing and gambling? Are there substantial differences or are there similarities? We'll now take a look at that. Both spending and investing will require an initial capital. However, spending will not improve your quality of life or offer any type of long-term gain. While it is enjoyable, spending offers no form of tangible asset return. Spending is also known as a depreciating assets, since these are often functional and necessary products that lose considerable value through extended use. Investing delivers a tangible reward in the future, whether this be in the form of capital, equity, or even qualifications that boost your earnings potential. Investing and spending will require an initial outlay or what you call capital. Investing is not the same as gambling, because gambling means putting money at risk by betting on an uncertain outcome with the hope that you might win money. There's often confusion between investing and gambling, and this lies more on placing a bet, let's say on a stock, based on a hot tip, which is similar to placing a bet in a casino. In investing preliminaries, these are some of the things you need to do or know before you start investing. One is living within your means. Spend only a portion of what you earn, and especially do budget control, because if you're already highly leveraged, meaning you've already had a lot of debt, then you might want to rethink your investing strategies. Two, adopt a savings program. This is going to give you solid and stable funding, which will be feeders for your investments. Investment created has therefore a life of its own. Three, establish lines of credit and risk protection. This may mean the likes of emergency cash replacement, creating an emergency buffer fund, or even getting covered for risk protection. Four, review existing investments. Investment objectives and types of exposure needs to be drawn out, and experience and knowledge has to be gained. And if you don't have that, then it's best for you to consult a financial advisor. And for other investment concerns, you need to make sure you have enough information gathering, analysis made, and management of your investments as well. Why do you need to invest? There are reasons for investing. One is to be able to protect your hard earned money and ensure its safety. Two is to be able to generate current income with which to meet your operating expenses and future financial requirements. And three, you need the desire to grow your principal funds for you to be able to achieve capital gains. Investing stages along the family life cycle. One way to draw up your investment program is to look at your particular family life cycle. In stage 1, ages 20 to 35, the objective is to achieve maximum capital appreciation by taking elevated but reasonable risk. In the earlier years, when you are young, the investor will need to purchase stocks that have fast revenue and earnings growth and high profit potentials. In stage 2, which is for ages 35 to 50, the main objectives of investing is to make capital gains and create a growing stream of income. Another objective is to develop a diversified portfolio to control the level of risk. In stage 3, which is ages 50 to 65, the objective in this instance is to maintain a high level of income flow and make some capital gains, and the relative safety of each investment is the primary consideration. For example, if you're looking at companies that are rated AAA, AA, or single A, say by Standard & Poor's and rating services, then these are deemed desirable. And lastly, for stage 4, if you're over age 65, the objective is to preserve capital and to live on the income of the investments. This requires selling individual common stocks and switching into very low risk assets such as treasury bonds. Aside from knowing the investing stages along the family life cycle, you also need to know your investing style. One investing style is the value investing approach. The strategy of selecting stocks that trade for less than the intrinsic value basically gives the investors a way to actively seek stocks of companies that they believe that the market has undervalued. They believe that the market overreacts to good and bad news, resulting in stock price movements that do not correspond with the company's long-term fundamentals. In this instance, the result is an opportunity for value investors to profit by buying when the price is deflated. The second investment style has to do with growth investing approach. This is a strategy whereby an investor seeks out stocks with what they deem good growth potential. In most cases, a growth stock is defined as a company whose earnings are expected to grow at an above average rate compared to its industry or the overall market. Growth investors therefore often call growth investing a capital growth strategy, since investors seek to maximize their capital gains. Another investment style has to do with income investing approach, a strategy whereby an investor seeks out stocks they deem to have stable dividend growth, which then provides regular income on their investment. Income investors are most concerned with companies displaying a healthy balance sheet, consistent dividend payments, quality products and services, experienced management teams. Those are the leaders in their respective industries, and last but not least, these are companies displaying steady earnings growth. Looking into the investor's life cycle and investment goals, we take a look at 4 phases. One is the accumulating phase. In the accumulation phase, early to middle years, you are accumulating for immediate needs and planning for long-term goals. Fairly high risk and high return investments also for the capacity to earn higher. In the consolidation phase, midpoint in your career, there are excess income for investing in future needs, and therefore you will want to go for moderately risky investments. In the third phase, which is spending phase, individuals retire and stops earning, and therefore lives primarily on savings and investment earnings, and therefore the investor will seek to protect assets. And finally, in the gifting phase, many run concurrent with spending, such as plans, estates, distributes wealth to loved ones, and contributes to society. This is understanding your initial requirements prior to the start of your investment.